So hello everyone. Sorry for making you wait. Just if you can drop me on the chat box if you can hear me well. So it's good, yeah. So we're gonna start today some follow up on what we did on the first time, and we're gonna talk about the language of Forex and what are the main terms that we need to know with giving examples in order to allow us to. So I hope you had a good day and we're starting now our session for today. So beginning with our trading sessions. As we know, in the Forex market, we have different time slots, as in the market opens in different part of the world. The Forex market is open 24 hours a day, 5 days a week, and that doesn't mean it's always active the entire day. The reason is we cannot get to the point. You can make money trading when the market moves up, and you can even make money when the market moves down. This is the normal thing when a trader is trading. But you will have a very difficult time trying to make money when the market doesn't move at all. So when the market is just sleeping, as in the market time is not the right time, it's going to be hard just to make money and move with the chart. So moving here to the time graph that we have, the Forex market trading times are important because it opens 24 hours a day, and the market is more active during different sessions, or when there's a crossovers between two sessions in different geographical locations. So, for example, as we can see here in the graphic, Sydney and Tokyo, they meet at the same time. Both they open and they are opened at the same time. One closes before the other. That's normal because each of them has another time. And as we can see, when Tokyo is about to close its session, London's session is open. Now we see the most important or the most tension or the most tradable timing is when London and New York time are combined together. So, for example, we're gonna give an example for when British pound and the USD experience a greater trading volume when both the European and US session are open between 3 p.m. and 7 p.m. Dubai time. So as we can see here, at 3 p.m. when the New York session opens, and at 7 when the British session closes. So at the beginning of each trading session, it's when the big institutions such as investments banks are active. This is often when relevant economic data for each session is published. So at this time, there is traders wait for economic news that are about to be released, and they wait for investment banks to open and to be active to see transactions. This will allow the market to move. So, for example, the UK's major data release come out at 11:30 a.m. Dubai time. So as we can see here in the graph, it's around 11:30. So it's gonna be here if you can see where I'm moving. And while the US tends to publish its data from 2:30 until 5:30 Dubai time. So it's gonna be around, if we can say this one is the winter time, so it's gonna be 3:30 until 6:30. Okay. Uh, these announcements can generate significant movements depending on the market's reaction. So every Forex trader needs to know when they are published. Of course, we support you with a Telegram channel that you can receive the news, timings, and updates. And this way, you can, as a trader, know what the news to come up on this day and what is the best time slot to trade on. So for example, if we have for today the news of, for example, the Federal Reserve is going to get up the interest rate. In this sense, we get to know at 6, for example, p.m. time, New York time, the Federal Reserve will talk or will have the speech to either increase or decrease the interest rate. In this sense, we know that this is a very important and the hot spot that we need to focus on. As you said, the UK's major data release come out at 11:30, just to keep it a note. And US trends to publish its data from 2:30 until 5:30. This is in winter. In summer, it's from 3:30 until 6:30. We're talking about hot sessions. Now moving into, of course, you can scan the barcode on the right, up on the right. This will take you to our Telegram channel. I'll give you like seconds. Maybe anyone wants to get into it. Anyways, we'll get back to it. So now we're going into the part of the language of trading. So we're starting with the basics as how to read a Forex quote in the Forex market. Prices are quoted in terms of other currencies. So there's always a currency against another currency. This is because there is no measure of value for opposing. However, the US dollar is used as a base currency for determining the values of other currencies. So as we can see here, the British pound against the US dollars, the base currency is the British pound, the code currency is the USD. So always there's two opposing currencies against each other. Now, we're starting with the word, what is pip? A pip, you need to become very familiar with the term pip if you're going to get into online Forex trading. You're gonna hear around everyone saying, Euro USD went by 10 pips, gold went by 10. So it's gonna be the word that traders use. So pip, which is PIP, stands for price in point or percentage in point. It's a pip is the fourth decimal point used in pricing. It's equivalent to 1% of 1 basis point. As most currency pairs are priced to 4 decimal points, it's the smallest price move than an exchange rate can make 0.0001. So it's always the fourth decimal point after, it's the fourth number after the decimal point. So always we look at the decimal point, we move 4 digits, and the fourth is the pip move. It can be 2 digits, it can be 3 digits, it depends on each and currency we are working on. Now, it's an important term to know for currency trading because the spread is actually quoted in pips, and we look at spreads later on. So here's an example to make it a bit clearer. You'd like to trade on Euro USD, and the price of Euro USD is 1.1060. Before you're about to enter the trade, you see that the price changes to 1.059. This means it decreased from 1.1060 to 1.1059. In this sense, there has been a fall in price by 1 pip. Why? Because as we can see, from the decimal point after the 1, we moved from here. If we count 1, 2, 3, 4, okay? This is a 0. Now, we take the 2 numbers because, of course, if here it was bigger than 0, we take this number. Now, we move into this number. We move 1, 2, 3, 4. It's going to be 9, 59. So this decrease from 60 to 59 is 1. So in other words, it's 0.001. So it decreased by 1 pip. Great. Now we're going to move into working out the value of pip. Each currency value fluctuates. So for us to be able to trade, we need to be able to calculate the value of a pip. It can be done in 2 simple ways. Step 1, of course, I'll get it into the details. Step 1, let's divide by 1 pip, which is 0.0001, as we said, by the current market value of your chosen pair. So for example, now if Euro USD is at 1.1005, I divide 1 by the current euro position that is now. So it's like I take the instant one. Step 2, it's multiplied that figure by your lot size. Now, this example allows us to say that Euro USD price is currently at 1.5510, and your lot size is a mini lot or 10,000. When we say mini lot or 10,000, 10,000 is equivalent to, as we can know, one lot is equal to 100,000. Okay, so 10,000 is going to be 0.1 lot, and mini lot we can count it at 0.01, which is equivalent to 1,000. Okay, so the value of the pip is 0.0001, as we mentioned before, and the current price is 1.5510. So we divide the pip value divided by the current price, we multiply it by how much the lot size. Here we get our either profit or loss. So I repeat this idea so it can be clearer. This allows us how to calculate our profit or our loss. So we count how much pips did this move. So it can be 0.001, it can be 0.0010, it can be 0.008. It depends on how much the currency is moving. The opposing one, when you divide it by the current price, as we said, and then after dividing this by this, we get a number, and then we multiply it by 10,000 or 1,000 or 100,000 or 20,000. It depends on the lot size you open. So, if example, you open 0.2 lots, it's gonna be 20,000. If you opened 2 lots, it's gonna be 200,000. So it depends on the lot size you open. This sense, you will get a number. This number will either be your profit or it will be your loss. So here, in this case, if the market moved by 1 pip, your earn or loss will be 0.6447 euros. So what is bid and ask price? As we discussed before, when you're going to be trading Forex, you need to be understand how currencies are actually priced. So there is always a price for each currency or each pair you're trading on. We know that currency are actually traded in pairs with the value of one currency appreciating and the other depreciating. It's either one appreciating or depreciating against the other. So when we buy and sell a currency pair, you're actually buying one currency while selling the other. So if we can see two currencies, for example, we're gonna keep Euro USD. Okay, so it's either you're buying one and selling the one opposing it. So it's either you're buying Euro and selling the USD or vice versa. It depends on the position you open. So the bid price is actually the price where you sell a currency pair. So it's price of buying the base currency against the counter currency. This is the difference between bid and ask. We'll get back to it. So we're moving now into spread. It's another common term in the Forex trading word, and it's something that every trader should ask before going into any platform. What's the spread? How much is the spread? What is the most suitable spread that I can have? It's a crucial concept that you need to understand when working out the costs involved while online forex trading. So the spread effectively means the difference between two prices. So it's always between the bid and the ask. It is the gap between the bid and the ask, as we said, and price of chosen currency pair. So it is important to note that a good broker have a lower spread. So we always make our best to offer lower spread and to ensure that you aren't priced out of trading. Although these spreads tend to widen in times of high market volatility, but as Godo will always offer you the lowest spreads available so you can trade effectively. As we know, when markets are at high points, it's going to be a very high spread, not that much high, but there's going to be movement in the spread. So that's normal. But as long as we said, as the broker gives you a decent one, it's going to be fair. But when the spread is widened, it means that there is a larger difference between the two prices. So between the bid and the ask will be a huge price difference. And these two prices is a good indication for market movements. This means that theoretically there will be a smaller spread when the market is more liquid. So when the market is moving normal, there's no big demand and supply, the spread will be very small, and this will allow you to be flexible more in opening trades. Now, here we go for an example. We have the Euro USD. We have Euro is the base currency, USD is the counter currency, or as we said in the first, we have the sorry. So we have one here the Euro USD bid and ask price. Here we have 1.2005. As you can see, this 5 is the pip count. 1.20008. 8 is the pip count. So we look at this number, and as we can see it moving up or down, we can calculate how much pips it's going up or down. How do we determine if up or down? It depends if we're buying. In this sense, we see if it's going up, how many pips it went up. If we're selling, we see how many pips it went down. That's logically speaking. So how do we calculate spreads? It's always the counter currency, which is higher, minus the base currency. So it's always ask minus bid. It's going to give me the spread. So 1.2008 minus 1.2005 is 3 points. This is our spread. The bid is the price at which you sell the base currency, and the ask price is at which you buy the base currency. Now, the spread is the cost that you incur from placing a trade. So every time you go and open a trade, you place a trade, there is a spread that it's going to be shown. When you open the chart, you're going to see two prices that are different. You're going to ask yourself, what's the difference between this and this? This and this, the first one is the bid price, and the second one is the ask price. I'm going to put a question mark in the middle and ask myself, what's the difference between bid and ask? Now I know that always in the market, there is something called like supply and demand. As we can say, bid and ask. So there is always this rule that there is this difference. We calculate this difference by subtracting the ask price minus the bid price, resulting in the spread. So keep in mind, always when you're searching for something, you ask for low spread or you seek for low spreads. So now we're moving to what is leverage and margin. So as we know before, to be familiar with the terms like pips and spreads, you'll also hear the terms leverage and margin more frequently. They're two terms that go hand in hand. So when we hear leverage, on the other hand, we hear margin. Leverage basically involves borrowing funds from your broker to enable you to control more funds when you're trading. This is done through the use of margin account and is partially responsible for the increase in Forex trading popularity. It effectively allows retail traders to control a lot more money than they actually invest. So here, I'm going to get into this, but I'm going to give the example first so it can be clear what leverage and margin is. So you've decided to trade with a leverage of 1:100. You've deposited $1,000 with your broker. However, you're actually able to control $100,000 for trading. In this sense, I came and I decided to open an account with $1,000, but in my balance, I'll see it $1,000. Back end, it will be $100,000. Now you ask yourself, why do brokers provide me with this? Keeping in mind that it can reach up to 400, so it can be 1:400, which is each $1,000 can make for me a $400,000. Now the question before entering into the details of leverage, why does the broker provide me with this? As we know, $1,000 can't even buy you an ounce of gold. An ounce of gold is something that everyone thinks that I need to keep it at home but I don't have the money, or I'm not capable of buying 1 or 2 or 3 or 4 ounces to keep them at home, safe. As we know, gold is always a safe haven. So this broker will give you the capability of a larger by providing you with leverage. So now you can trade with $100,000. Your balance is $1,000, but back end it's $100,000. And as we can say that as long as we are giving the leverage 100, your profits will be multiplied by 100 if you calculate it with the formula that I'll be showing, and your losses will be as the same calculation will have it. So what profits you do, the loss will be, the risk is on both. This will help you to buy more than 1 ounce. It depends on the lot size that you buy, and this will allow you also to open another opportunity. For example, if you want to open with gold, you can also take some positions in Euro USD. This goes back to what's your interest. So when you're trading, the profit that you made on a trade is actually amplified because you're using more money to trade that you have effectively borrowed from your broker. So how to trade currencies in Forex? The value of each currency depends on the supply and demand for it. Supply and demand, it's an economic term. It's well known in everything, in trading, not only in Forex trading, it's also known in any trading system in life. You trade in PCs, you trade in Go, whatever, there is a supply and demand. These two factors are things that we know as how much demand and how much supply on this product. So the value of each currency depends, as we said, on supply and demand for it. The exchange rate itself is basically the difference between the value of one currency against another. And it's this exchange rate that determines how much of one currency you get in exchange for another. So for example, how many pounds you get for your euros. So if you go now and you look at the price of pound and euros, and I want to do this exchange, I'm gonna see how much is the difference, and I'll see how much there is demand and supply on each of the currencies. At this point, it's important to remember that the exchange rate is continually fluctuating. So every time you won't see it stable, you will see it moving. That's something for sure normal, and we can't move with anything. So I'm gonna give here, if you can just note them in. I'll be sending you this presentation, of course, to keep it as a reference. I'll be showing you now some terms we need to know, some terms that when you are trading, you have to know when the movements of this market, for example, appreciation. It's an increase in the value of exchange rate. So when there's appreciation, when there's an increase in the value of exchange rate, this is called an appreciation. When there is a decrease in the value of an exchange rate, this is called depreciation or devaluation. So appreciation and depreciation. And then we have gapping. It's an opening price significantly above or below the previous day's close with no trading activity in between. So, for example, the market closes on Friday at night and it opens on Monday. Sunday at night, Monday morning. So this gapping is, in other words, if Friday gold closed on 1950, okay, and on Sunday at night, Monday morning, it opened on 1970. That's gonna be a $20 difference. This is called a cap. So this means that a limit or stop order could be filled at a price different from the desired order price. So uh, before closing the market on Friday, you can place an order and move from there. So this is for gapping. Risk management. Whenever you are trading, there's something called risk management. It involves the use of strategies in order to help control or reduce financial risk. An example is a stop loss order, which is used to potentially minimize losses on a trade. So as a trader, I'm not gonna recommend, but I advise that stop loss is something that allows you to manage risks. A stop loss order is a risk management tool allowing a position to be closed once it reaches a specific preset price. This can protect against further losses on an open position if prices continue in an unfavorable direction for the investor. So, for example, if I took a position of gold on 1950 and it was a buy position. So a buy position, so I'm aiming that the gold price will increase from 1950 and I'll say it's going to move up to 1960. But the market went against what I said and it went to 1945. Okay, so when I placed the order, I set my stop loss to 1944. In this sense, I'm saying that when gold reaches 1944, please close uh, my trade. In this sense, the trader will know that from 1950 to 1944, it depends on how many lot size he opened. He will manage his risk. In this sense, he will say or she will say that my loss is, for example, $6, I will know that this is my loss. Okay. So stop loss will allow you to identify your loss and will allow you to manage risks. Now, take profit. A take profit order is a risk management tool also, allowing a position to be closed automatically once it reaches a specific preset profit goal. And this can protect against profits being lost in an unexpected reversal of price directions before the investor can close the position. So it's different than stop loss. This one is take profit. It's same idea. Stop loss reaches with minimal losses as you put a limit for your loss. Take profit when you put limit for your profit. As we know, greediness is not something we want in this business. We want how to manage risks and how to move with the trade safely. So always we open a position, we apply take profit position and stop loss. So the word profit and loss, it proceeds for a trade, which are from realized post trade positions. And I think we're done for today. I'll just give a brief of what we identified in this session. We talked about basic terms that are the language of trading, in which it will allow you to know more what you are expecting in the future steps. Hopefully, our next session will be how to read news and the analysis of news, in which after we discuss today the terms that allows you, if you open MetaTrader, it will allow you to know how to manage each word there. So if you see margin level, balance, equity, all this, we discussed them last session and this session, and this will allow you to uh, uh, trade easily. Next time, we will be talking about news and how to read the news and how to wait for the news, as we also today mentioned the timings of the slots. Now, allow me to open the questions on the chat box. If anyone has any question, I'll try to answer. So I can see I have like 4 questions. One of them is if I have $100, what trade size I will go for. For $100, you can start with mini lot. So when we talk about mini lot, it's 0.01, 0.02. It all goes back to your decision, but always move, as we said, with mini lots. This is part of managing risks. 0.01, 0.02 are the best to use for small capital. Now, moving on for the second question. Do you think I use leverage 100 or 400? What do you suggest? This goes back to you. This goes back to how much you're willing to invest. Leverage is something you decide on. This will allow you to open, as we said, more positions. This will grant you better opportunities. This will allow you at the same time to make sure that you can manage this risk at your own uh, maybe plan that you are willing to enter in. Another question is, what do you think is the best time to trade in? This goes back to you on uh, what currency you are working with. So, for example, if, as we said, you want to work with British pound and USD, the best time it's going to be from 3 till 7 p.m. in Dubai time. Since this time, both sessions will be open. Uh, our pleasure, our pleasure. So anyone else needs to, I'll be sending back to you this PowerPoint presentation. I'll update you with our next. Okay. So thank you guys for today and hope to see you on our next webinar.